Most traders start trading the exact same way. They learn a setup that tells them when to enter. Fair value gaps, order blocks, support and resistance, trend lines. And at first, it actually feels like it works. Price comes into a fair value gap and rallies. Support holds perfectly. An order block reacts cleanly. So naturally, the trader starts trusting the setup more and more because it feels like they finally found something consistent to follow. But then something confusing starts happening. The exact same setup that worked perfectly yesterday suddenly fails today. So the trader starts adjusting things. Maybe they need better confirmation. Maybe the setup only works during certain sessions. Maybe the higher time frame wasn't aligned. But while the trader keeps refining the setup, something strange keeps happening in the background. Sometimes the market moves aggressively without ever forming the setup they were waiting for. And that creates a much bigger question traders almost never stop to ask. If the setup itself is supposed to create the edge, then why does the exact same setup behave differently depending on the type of price action you use it in? So let's actually test this properly. Same setup, same rules, same time frame. The only thing we're changing is the type of price action the setup is used in. First, look at this period here. Price is moving strongly to the upside. We'll use the exact same FVG model every time during this move. Over this 2-hour period, the bullish fair value gaps had 9 winners and 5 losers. The bearish fair value gaps had 1 winner and 5 losers. Now compare that to this environment. Completely different behaviour. Price is choppy and rotational. It's constantly moving back and forth. But we're still using the exact same FVG model. Same rules, same entries, same time frame. This time, the results completely change. The bearish fair value gaps had 4 winners and 8 losers. The bullish fair value gaps had 3 winners and 5 losers. You see, nothing about the setup changed. The only thing that was different was the type of price action it was used in. And once you see this, something becomes very difficult to ignore. The setup only performed well when it was aligned with price action that supported it, not because the setup itself creates the edge. Now, most traders would hear this and say, well, obviously, you just need to trade the conditions where the setup works the best. But that literally exposes the problem with your trading strategy. Because if your setup only works when a type of price action already exists, then the setup itself is not where the edge is coming from. The edge comes from using the setup in the right type of price action. It only works well because the price action already supports it before it even appears. And once you realize this, something starts changing about the way you look at trading strategies. Because traders spend years searching for better setups, cleaner entries, more confirmation, better models, without realizing that they all depend on the price action being there first. Which means the edge was never actually coming from the setup itself. Now go back to that strong bullish example again. Look at what price was actually doing. It was pushing higher, coming back slightly, then continuing higher again, then pulling back slightly again. The market keeps offering opportunities to participate in the move, but the trader can't take them because they're not allowed to enter until the setup appears first. No fair value gap, no trade, no clean pattern, no entry. So while price is aggressively continuing, the trader just sits there waiting for the setup to become valid. And this is where trading quietly becomes backwards, because the trader thinks the setup is filtering bad trades out, but the only thing the setup is doing is filtering them out of taking trades. You can see price was already moving, but the strategy forced the trader to ignore this unless a specific pattern appeared first. Now obviously this doesn't mean you should randomly buy and sell with no structure, and it doesn't mean all setups are useless either. The problem is how traders treat them. Most traders build their entire approach around waiting for patterns before they allow themselves to enter, instead of actually building their approach around the price action first. And once you realize this, the way you look at setups starts changing completely. You stop treating them like things that create the opportunity and start treating them like something used to read price action. That's a completely different mindset from the fair value gap appeared, so now the move is valid, because the move was already valid before the pattern formed. And once that clicks, you stop obsessing over finding the perfect setup and start focusing more on understanding the price action itself. That deeper shift is exactly what I explain in my Seeing Price Clearly series, because the setup never created the opportunity, the movement did.